Oh, hi there. My name is Mandeep Burmi. I'm a full-time Forex trader. In this video, I'm going to show you guys how to trade Forex reversal patterns. I will show you when you should enter in a trade, where to place your stop loss, and where to take your profit target. And most importantly, my 3 rules to trade any Forex reversal pattern. Now, here are my 5 favorite high probability reversal patterns. Number 1, head and shoulder. Number 2, inverse head and shoulder. Number 3, double top. Number 4, double bottom. Number 5, triple failure. So let's go to the charts and look at some theoretical examples first, and then we will also look at real market examples. I will show you guys exactly where to place your entries, your stops, your profit targets, and my 3 rules to trade these high probability reversal patterns so you can make money trading Forex market. So here we have the first Forex reversal pattern, head and shoulder. Head and shoulder indicates both the end of the trend and the possible change in the direction of the price movement. Head and shoulder is formed in an uptrend, and the two lower spikes or the two lower peaks called shoulder are located at two sides of the highest peak called the head. So here we have a shoulder, left shoulder. On this side we have a right shoulder, and then in the center we have this highest peak, we call it head. So basically you have an uptrend, so price is making higher highs, and then you have a key resistance level here. Price comes to your key resistance level, it rejects from your key resistance level, then price takes another leg up, and this time price break from your key resistance level, but then it quickly gets rejected, and then price does another retest of your key resistance level, and then when price breaks through this minor support line, that's where we will take our sell entry, and the profit target should be the base of the spike. Now let's look at some real market examples to really understand head and shoulder so we can make money trading Forex market. Here we have a real market examples of Forex head and shoulder reversal pattern. We have a price spike going into our key level, and then price gets rejected. It came down to the small consolidation base within this price spike here. Price came back up, and this time price actually closed above the key resistance level, but then price was quickly rejected, and then it came back to that same support level here. Price does another retest of that same key resistance level, and when price comes down and close below this support line here, that's where we will take our sell entry, and we are expecting the price to come all the way down to fill up this open spike. Now here are my 3 rules on how to trade Forex head and shoulder reversal pattern. Rule number 1, you must have a key resistance level coming from a higher time frame. So if you're trading head and shoulder pattern on a 30 minutes time frame, then the key resistance level has to come from 1 hour, 2 hours or 4 hour time frame. Rule number 2, you must have an open spike going into your key resistance level. Now this is extremely important, because when price breaks below this support line here or below this neckline, we are expecting the price to fill up this open spike on the left side here. So it's extremely important that we have this open spike. If you have a lot of consolidation within this open spike, then I would consider that as a low probability head and shoulder reversal pattern. The high probability head and shoulder reversal pattern will have very clean open spike going into your key resistance level, and your profit target should be the base of the spike. As you can see here, price broke below this neckline. Price quickly came down to the base of this open spike, and then we see price came back up to this consolidation base. So now let's look at the next Forex reversal pattern. Then now the next Forex reversal pattern is inverse head and shoulder pattern. Inverse head and shoulder pattern is very similar to the head and shoulder pattern, but it is formed in a downtrend. So here we have a theoretical example of Forex inverse head and shoulder pattern. Market is in a downtrend, so price is making lower lows, and then price hit our key support level, and price is quickly rejected. Price does another test of that same key support level, and this time you can consider this as a false breakout, and then price test that same support level one more time, and when price breaks above this neckline here, that's where we will take our buy trade, and we are expecting the price to fill up the open spike on the left side. So it's very similar to the head and shoulder pattern that we just covered. Now let's look at the real market example of inverse head and shoulder pattern to trade Forex market. Here we have a real market example of inverse head and shoulder reversal pattern. We see prices making its prices in downtrend. It's making lower lows, and then we have a key support level here, which is coming from a higher time frame. Price hit our key support level, and then it quickly got rejected. And as you can see, price came to this consolidation within this open spike here. Then price took another leg down, and it was quickly rejected, which will form head of our inverse head and shoulder pattern. Then price does another retest of that same support level, and then it was rejected again. When price closed above this neckline here, or above this support line, in this case actually it's a resistance line, excuse me. So when price closed above this minor resistance line, that's where we will take our buy entry, and we are expecting the price to fill up the open spike on the left side. So same three rules apply on this pair as well. You must have a key support level coming from a higher time frame. Rule number one, we must have an open spike. In this example, the open spike was actually it's not ideal spike. Ideally you don't want to see consolidation like this one here. So I would actually consider this as a low probability head and shoulder pattern. But in this case it still works out really good. Okay, and then the rule number three is your risk. You must control your risk, and you should not risk more than 0.5% on a single trade. Doesn't matter which Forex reversal pattern you are trading. So let's look at the next Forex reversal pattern. The next on the list we have a double top high probability Forex reversal pattern. Now double top indicates both the end of the trend and the possible change in the direction of the price. Double top is formed in an uptrend. If it takes much time for the pattern to be formed, then more reliable it will be. For example, double top pattern formed on a 4-hour time frame are much reliable than the double top patterns formed on a 5-minute time frame. So here we have market in an uptrend, and then you have a key resistance level here. Price spikes up to your key resistance level and then it quickly rejects. Then price does another retest of your key resistance level, and when price rejects your key resistance level again, it will form the second top. And when price breaks below your minor support level here, that's where we will take our sell signal, and we are expecting the open spike to get filled. So let's look at some real market examples of Forex double top pattern. Here we have a perfect example of Forex double top reversal pattern. Now this pattern, as I said, if you're trading this pattern on a higher time frame, it can bring a lot of profit to you. Here are my 3 rules on how to trade Forex double top reversal pattern. Rule number 1 is you must have a key resistance level coming from a higher time frame, similar to what we covered in the first 2 reversal patterns. Rule number 2 is you must have an open spike going into your key resistance level. And rule number 3 is you must control your risk, and you should not risk more than 0.5% of your account size on a single trade. Now let's break down the rules. So rule number 1 is your key resistance level. So you would have your key resistance level here, and when price is spiking higher to your key resistance level, then you're looking for a consolidation, a minor consolidation within that open spike, because that's where the price will retrace back to. So in this example here, the minor consolidation is in this area here. Price was quickly rejected from the key resistance level and it came down to this minor support or consolidation. Price does another retest of that same key resistance level, and when price breaks below this consolidation base, that's where we will take our sell entry, and we are expecting the price to fill up the open spike, and that will be your profit target. Your stop will simply go above the tops. So here we have top 1, here we have second top, and that will form our double top reversal pattern. Now let's look at the next reversal pattern. Next on the list we have double top reversal pattern. Double bottom reversal pattern. Double bottom reversal pattern is very similar to double top Forex reversal pattern, but it is formed in a downtrend. For example, here we see market is trending down, and then you have your key support level here, which is coming from a higher time frame. Then you would look for a small consolidation within this open spike. You're expecting the price to hit your support level and then come back up to this minor consolidation base here, and then you're expecting the price to come down again to your support level, and that will form your double top pattern. When price breaks above this consolidation base or your neckline here, that's where we will take our buy signal, buy entry, and we are expecting the price to fill up this open spike on the left side. Now let's look at some real market examples of double bottom pattern. Here we have a perfect example of high probability double bottom reversal pattern to trade Forex market. So here we have prices spiking lower to our key support level. Price came back up. Now in this case, this spike is actually looks very clean on this this time frame here, and this is actually from a 1 hour time frame. But if you move down to 15-minute time frame or 5-minute time frame, then you will see a small consolidation here. Price came to this small consolidation, and then it got quickly rejected from that small consolidation. It came back down to this key support level that will form our double bottom. When price breaks above this consolidation or this neckline here, that will give us a buy signal. That's where we take our buy entry to trade double bottom reversal pattern, and we are expecting the price to fill up this open spike here. So your profit target should be the base of the open spike, and your stop will simply go below the bottom here, below the low of this bottom. um, so it's very simple to trade forex double bottom pattern. And again, if you're trading this on a higher time frame, then it can bring a lot of profit to you, because the double tops and the double bottom patterns formed on a higher time frames like 2 hours or 4 hours can bring a lot of profit because they are very reliable. So let's look at the next reversal pattern. Now the next reversal pattern on the list is a triple failure or triple top reversal pattern. So basically price made 3 attempts to break a key resistance level but failed and released to the downside. Same thing here. Rule number 1 is you must have a key resistance level, and your key resistance level has to come from a higher time frame. Rule number 2 is you must have an open spike going into your key level. And rule number 3 is you must control your risk. You should not risk more than 0.5% on a single trade. So let's look at a real market example of triple failure. So here we have a real market example of forex triple failure that brings us lot of money, lot of pips. So we have a key resistance level coming from a higher time frame. Price is spiking higher, and price hit our key resistance level. In this case, price just moves sideways, and then it does another retest of that same key resistance level. It got quickly rejected, and then price later on price does another retest of that same key resistance level. And when price starts to trade below this neckline here, that's when we will get in the sell trade, and we are expecting for the price to move all the way down to fill up this open spike on the left side. So these are my favorite very high probability reversal patterns to trade the forex market. If you want to learn more about forex trading, then please visit my website burmefxtrading.com. I will teach you one very simple strategy that provides very high reward to risk ratio. Average reward to risk ratio is 3 to 1. Average stop loss is less than 10 pips. You can trade any session, you can trade any direction because we are volatility traders. So with this strategy, you can trade any direction. You don't need any fancy indicators. We are trading pure price action. This strategy is perfect for day traders and scalpers, and it will provide trading opportunities every day. So it will keep you busy with something that you have a lot of passion for.